Chris Picciurro here with Teaching Tax Flow. Last week we mentioned that President Biden put out details regarding his 2024 budget proposal, and I wanted to walk through that with you. There's been a lot of interest, a lot of questions in the Teaching Tax Flow community. Just want to give you my thoughts and kind of break down what that might mean for taxpayers and maybe what planning opportunities could exist. I want everyone to remember we are still in a very low tax rate environment. We're still under the Tax Cuts and Jobs Act of 2017. So let's check this out. This I want to walk it through today is put out by the Tax Foundation. For those of you that don't know, Tax Foundation is a bipartisan, nonprofit organization that breaks down tax law and the impact it's going to have or expected impact on our economy. So if we look at, you can see there's a bunch of contributors here. The President Biden's budget would essentially lead to a $2.5 trillion reduction in the federal deficit through, if you add up all of the cuts and all of the increase in taxes, through the end of 2033. Now, you can download a spreadsheet that details that right on the website that I'm on, and you can dive into that spreadsheet. The biggest theme here is that the president is proposing higher marginal tax rates. We talk all the time in the Teaching Tax Flow community that your marginal tax rate is more important than your tax bracket, and that's the most important number when it comes to tax, and in my opinion, financial planning. So marginal tax rates are expected to increase. This proposed budget has some other ramifications that the Tax Foundation expects. We expect GDP to go down 1.3%, and we expect the net of full-time jobs to be reduced by about $333,000 or $335,000. Okay, so those are some of the bigger expected results that the Tax Foundation has said. So you can see it's mixed results. It's nice that the deficit goes down, but the GDP reducing, wages going down, and jobs getting reduced is obviously a concern. Let's look at the major provisions. One, the corporate tax rate right now, so for C corporations, regardless if you're a small corp or big corp, is a flat 21%. The president's proposing that goes up to 28%. So that's a 33% increase on corporate taxes, and that would be effective immediately. So that would be this year. So if you have a corporation and you have taxable income, and if this does pass, you're gonna want to start doing some tax strategy immediately because your tax rate is going to be increased by 33%. A couple of other things. There's the concept called the GILTI tax. That's a tax on international companies. I'm not going to dive into that because it really doesn't apply to a ton of taxpayers, but that's supposed to double. Capital gains, there's some major changes in capital gains. The net investment tax, or the NIT we call, would increase and go up to 5%. I'm reading right here. The top individual tax rate would go up to about 40%, up quite a bit. And then the tax on long-term capital gains and ordinary dividends, and qualified dividends rather. So this is something that we really preach in Teaching Tax Flow, of the importance of that lower tax rate on long-term capital gains and qualified dividends. The lower rates would be changed for people with taxable income above $1 million. And also, if you at a state, there'd be an additional estate tax for unrealized capital gains at death. So what that means is that if you bought a stock for $1,000 and it became worth $10 million, even if you don't sell it, you might be subject to tax. It would limit IRA or retirement account contributions for high taxpayers. What's that telling you? We always talk about tax rates are going to go up in the future and the power of tax-free income and growth. So if the proposed tax is saying we want to limit the ability to put money into retirement accounts for high-income taxpayers, that tells you that if you are currently a high-income taxpayer, you should deeply consider putting money into retirement accounts. The other major thing is the potential limiting of the 1031 exchange to only $500,000 worth of gains. Now, we know that $500,000 gain figure is the maximum tax-free gain if you sell your primary residence and you qualify for the Section 121 capital gain exclusion and you are married. Just found that really interesting that number is the same. Obviously, if 1031 exchanges can only exclude up to $500,000 of gain, that's going to completely change the landscape of real estate. And that, coupled with potentially higher capital gains taxes, that could make selling property not as advantageous. The proposal does introduce potential tax credits that you're looking at, which would be the advanced child tax credit, a larger earned income credit, and premium tax credits for people that have a subsidy for their health insurance and qualify under a certain income threshold. So a lot of stuff going on with these proposals. Again, I'd encourage you, if you're interested, to check out the Tax Foundation. Also, make sure you're following us. We're going to continue to put great content out about potential tax changes, and check out the Teaching Tax Flow podcast. We talk a lot about tax-free income versus tax-deferred income. All right, thanks for watching, and thank you for being part of the Teaching Tax Flow community. Have an awesome rest of the day.